Good morning, ladies and gentlemen, and thank you for tuning into the presentation today. My name is Charlie Jackson, and I'm a professional assurance surveyor in the regulation department at RICS. It's my team's job, when we're not in the middle of a global pandemic, to carry out regulatory reviews of firms' and members' valuation activities and make sure they're in compliance with Red Book requirements. Being a valuer, as most of you will know, is rarely easy, but at the present time, it's extremely difficult. And in some cases, it's impossible. Amongst other things, lack of transactional data, inability to carry out inspections, difficulty in obtaining key information, and pressure from clients to predict the future can make it very difficult to formulate an opinion of value in which you can have confidence, and that valuation uncertainty carries with it increased risk, both to the client and to the valuer. The best way to reduce risk in these circumstances is to make sure you follow the requirements and guidance of RICS as closely as you can in order to protect yourself if you're faced with a challenge at a later date, as unfortunately some of you listening today may be. My intention is that this webinar will help you understand what you have to do in practical terms to comply with the requirements of Red Book, how to tackle the challenges posed by COVID-19 from a compliance perspective, and thereby reduce risk to yourselves and your clients. The presentation will last for approximately 45 minutes, and at the end I'll be joined by my colleague John Bagley, who is RICS's Tangible Assets Valuation Director, and between us we'll try to answer as many of your questions as we can, so do please keep those coming in. If you are a member of RICS providing valuation advice, then you must register as a valuer on the Valuer Registration Scheme and comply with the requirements of the RICS Valuation Global Standards, otherwise known as Red Book. Valuer registration is the global gold standard for valuation and includes regular risk monitoring and quality assurance of valuers' work by the professional assurance team at RICS. The professional assurance team works to ensure valuers' compliance with Red Book and shares with them practical ways in which to comply with the standards and best practice procedures. There are currently approximately 16,500 registered valuers and 3,250 sponsoring firms on the Valuer Registration Scheme spread right across the world, and all facing similar challenges during this coronavirus pandemic. Valuer registration is now mandatory in 214 countries, as shown in red on the map, which means that if you are a member of RICS and you're carrying out valuation activities in any of these countries, you must register on RICS's Valuer Registration Scheme. Registered valuers must make sure all the written valuations they produce comply with the requirements of Red Book, which was updated in January, so make sure you are using the most up-to-date version. Valuers are allowed to depart from Red Book in certain circumstances in order to meet local requirements, which we will come on to later, or very occasionally to meet client requirements, although this is rare. Any departures you do make must be clearly identified as a departure in both the terms of engagement and the valuation report, explaining to the client why you are making the departure and how this might impact the advice you're providing. Whilst there are no exemptions from Red Book, Professional Standard 1 towards the front of Red Book Global sets out some exceptions to the requirements of sections VPS 1 to VPS 5. Even in these circumstances, RICS still encourages valuers to follow these sections as best practice. But if the whole of the valuation activity you undertake falls within these exceptions, there is no requirement to register on the Valuer Registration Scheme. Valuer registration is of benefit to a range of stakeholders, not least of all to members, for whom it is the badge of integrity and competence, thus giving them a competitive advantage in their market. It is the gold standard of valuation, and the professional assurance provided by RICS lessens the risk of statutory intervention in regulation. Enhanced regulation also provides consumer protection to the public and gives greater confidence both to them and to lenders and investors who want consistency of standards across valuation professionals. Valuer registration is recognised by major banks and building societies worldwide who are again looking for consistency. It was this desire for consistency from banks that led to the publication of the first Red Book back in 1974, and the demand for harmonising standards has only grown since then. Many of you will have heard about or indeed experienced a contraction of the professional indemnity market, and for insurers, proven compliance with the requirements of the regulator improves their confidence in valuers and firms seeking insurance and gives VRS members greater access to the professional indemnity market. The assurance that goes with valuer registration gives governments confidence in the self-regulation of the profession and, as big employers of surveyors, confidence in their own public sector valuation professionals. So these effective, robust checks by RICS that form a significant part of the valuer registration scheme are a benefit to everyone by continuing to raise standards and minimising risk to valuers and end users alike. Let's look now at the approach we take to monitoring compliance amongst valuation firms and members. A significant part of our monitoring process is carrying out reviews of valuers' work. We take a professional and transparent approach and select who to review based on risk. We determine risk in a number of ways, mainly from the information you provide to us each year in your annual return, but also from intelligence we receive through things like complaints, whistleblowing, or information that has come to us by some other means. Whatever the reason for the review, we will be transparent and clear about the reason for it. The review will focus on key issues, and any non-compliance with the requirements of Red Book will be risk assessed by the reviewer. The reviewer will, in every case, be an experienced valuer themselves. The reviewer will then share feedback and best practice, explaining what the valuer needs to do to close any gaps in compliance and better protect themselves going forward. We take the view that leading valuers into compliance through practical help and advice is better than enforcement, with disciplinary action always being the very last resort. Let's look then at what valuers should do to comply with the requirements of Red Book, particularly during the current pandemic and at a time of valuation uncertainty, and what you can do to reduce risk to yourselves and to your clients. Users of your valuations want assurance that the valuer is competent and qualified and that there are no conflicts of interest. They want all documents to be written in plain and clear language so they're easy to understand with all the technical terms defined. They want compliance with the relevant valuation standards, and they want consistency. So if they instruct a registered valuer anywhere in the world, they know what they're going to get and that the valuation will be prepared to the highest standard. By following the requirements of Red Book, you will ensure that your report is fit for purpose and that your client can have confidence in it. It will also help you defend yourself if you are accused of being negligent in the preparation of your valuation and report. If you fail to comply with Red Book, you can fatally undermine your ability to defend yourself against an allegation of negligence, as the job of a valuer is not simply to provide the client with a correct opinion of value. The job of the valuer is to provide an opinion of value which can be demonstrated to be reliable because it has been arrived at by following a comprehensive, structured, analytical, calculated, and reasoned approach. Red Book is a risk management tool and therefore a book that you should become very familiar with because one day it could turn out to be your best friend. Your first line of defence, if you are accused of negligence, is to be able to say that you did it by the book. If you did it by the book, you have not been negligent. But it is not enough just to comply with Red Book. You must be seen to comply. And this means keeping a comprehensive audit trail in the file from your first contact with the client right through to your report. The audit trail is your first line of defence and is the way you reduce risk to yourself. Your audit trail should, as a minimum, contain a note of the prior involvement and conflict of interest checks you undertook prior to accepting the instruction, as per Professional Standard 2. Terms of engagement fully compliant with VPS 1, along with evidence that these have been settled with the client. Notes of all relevant site inspections, enquiries, any third-party information you've relied upon or information received from the client, along with a note of the steps you took to verify that information in accordance with VPS 2 and VPGA 8. All relevant comparable transactional evidence, along with notes of your analysis, any valuation calculations you did, but always your rationale and any contemporaneous notes of your thought process. And lastly, your valuation report, fully compliant with VPS 3. That forms the audit trail that you should keep on file, either in paper form or electronically, but held together clearly and logically to demonstrate that you not only followed the requirements of Red Book, but did so methodically and professionally as expected of an RICS registered valuer. Let's look a bit more closely at the detail of the audit trail to see how to better reduce risk and defend any challenges to your work. PS2 is about ethics, competency, objectivity, and disclosures. In order to comply, you must make sure the audit trail on file includes robust prior involvement and conflict of interest checks. There are two parts to this check, the first being prior involvement with the property and the parties to the instruction, and the second being whether any prior involvement would constitute a conflict of interest. Whether the answer to those checks is yes or no, the findings of the checks need to be noted on file, even if it's only to say that you've never seen the property before. The checks must also be cross-discipline, so don't just check with the valuation department. These checks must be across the whole firm. The terms of engagement and valuation report that you issue to the client must also contain a clear declaration of the findings of your checks. So the results of these checks need to appear in three places: in the file note, in the terms of engagement, and in the valuation report. In respect of competence, do not accept an instruction that would be on the outer edge of your knowledge, experience, operational area, or specialism. In the current climate, it is more important than ever that you stick to what you know. To go outside of your area of expertise at a time like this would be taking a huge risk, as it's uncertainty on top of uncertainty, so don't do it. You need to be able at all times to demonstrate your qualification for the valuation task, and one of the easiest ways to do this is to keep on file an up-to-date CV or resume for all valuation staff. VPS 1 deals with the minimum content of the terms of engagement document, which must be issued in all cases unless you have a formal service level agreement in place with the client. This is not a time to be acting on trust and a handshake, and to have settled terms of engagement in place for all valuation instructions is a mandatory requirement of Red Book. The terms of engagement must be case-specific, so not standard and generic. They should be tailor-made for the particular instruction. All the matters listed in section VPS 1, paragraph 3.1 must be included in the main body of the document on a case-specific basis. This means that they must not be relegated to a standard appendix. They must be clear and bespoke. The purpose of the valuation must be clear and unambiguous. In other words, you need to state why the client wants you to undertake this valuation. What is he going to use it for? To say the purpose is to provide an opinion of market value isn't enough. You must say why you are preparing this valuation. Is it for secured lending or taxation or financial reporting or acquisition? The purpose must be clear. If the client won't tell you the purpose, you should think very hard about whether or not you want to accept the instruction at all, as the purpose drives everything else. And if you don't know what the purpose is, how can you be sure the report will be fit for purpose? In order to protect yourself, your terms of engagement must make it clear exactly what the report can be used for and who may rely upon it. Without limiting the use of the report, you may be unwittingly opening yourself up to more liability than you want. Your terms of engagement should also make it very clear about exactly what you will and will not be investigating as part of this valuation exercise. And again, this should be stated on a case-specific basis, as should the consequent assumptions you'll be making. Failure to issue and agree compliant terms of engagement puts the valuer, the client, and any associated stakeholders at risk. So make sure you're familiar with the requirements of VPS 1, paragraph 3.1, and that your terms of engagement include every item listed. There's a framework document available to download for free from the RICS website, which makes a useful terms of engagement template if anybody's interested. The link is available at the end of this presentation. VPS2 deals with inspections and investigations, which must be professionally adequate for the valuation purpose. The site notes should be in written or typed form, so not just a load of photographs, and they must demonstrate that the valuer has inspected and noted all relevant areas. Information sources should be verified as far as possible, and the valuer should use some professional skepticism to ensure that the information is reliable. If lack of information means that you will need to make some assumptions, these should be agreed with the client and made clear in the terms of engagement and valuation report. VPS2 interacts with VPGA8 towards the back of Red Book Global and concerns the valuation of real property interests. VPGA8 is advisory rather than mandatory, but includes a list of matters that typically affect the value of a real estate asset and is therefore a useful aid memoir for the valuer to ensure all relevant matters are covered in his site inspection and investigation notes. During the COVID-19 pandemic, with lockdown and social distancing measures in place, site inspections have been difficult, impossible, or simply unwise. RICS's advice to surveyors at this time is not to carry out any non-urgent surveys in homes where people are in residence, and certainly no inspection should take place if any person in the property is showing symptoms of the virus, is self-isolating, or is shielding. The surveying profession has shown real agility in terms of its adoption of technology, as this webinar proves, and so it may be possible for valuers to carry out some of their work online. It may also be possible to carry out urgent surveys on empty properties or those where the occupants are out of the property or following guidance to stay at home but away from others. If there are going to be restrictions on your inspections, such as carrying out an inspection only of the property's exterior or using technology to carry out a virtual inspection, then you must consider whether this restriction is really reasonable in light of the valuation purpose and the client's requirements. The more restrictions you have to work with, the greater the valuation uncertainty. So perhaps consider accepting the valuation instruction subject to certain conditions, such as the condition that the valuation report is not to be published or shared with third parties. In this way, you can limit your liability. If you decide that it is not possible to provide a valuation, even on a restricted basis, then you should decline the instruction. This is a decision for you, using your professional judgment and weighing up all the circumstances. Only you can decide if undertaking the valuation would be an acceptable risk. As well as inspections and investigations, VPS2 covers the requirement to keep proper valuation records on file in an appropriate business format, which can be in paper form or in an electronic form if you prefer. What is important is that all your investigations, analyses, and key inputs into your opinion of value are documented and held together on file for you to refer to at a later date if needed. Your site inspection and investigation notes should not only include your findings, but also a note of any restrictions you faced, such as a limited inspection due to COVID-19 or a locked room that you were unable to access, as well as the circumstances of the inspection, for example, your time on and off site, the weather, or who accompanied you on the inspection. This is important in case you are challenged later about the circumstances of the inspection, such as if the client says you were only at the property for 5 minutes, so couldn't have carried out a thorough inspection. Your notes should be able to defend you. Your file notes should also include a record of the key inputs into your valuation, your investigations and analyses, and any calculations you did, along with contemporaneous notes describing your valuation rationale. Although this information will probably be included in your valuation report, it is important that it is also in your working notes on file in order to demonstrate that you followed a methodical and logical process of information gathering and analysis as required by Red Book. The rule of thumb is that if it isn't written down, it didn't happen. And if it didn't happen, the valuer, client, and other stakeholders are put at risk, along with potential reputational damage to RICS. Now is a time of material valuation uncertainty of a kind the profession has never seen before, and valuers are faced with a very challenging set of circumstances on which to base their judgment. If you decide to accept a valuation instruction and make a valuation judgment, then VPGA 10 of Red Book, which deals with matters that may give rise to material valuation uncertainty, tells us that you must put that judgment into clear context in your valuation report. This means that you should expressly draw attention to and comment on the issue that has caused this material uncertainty in the valuation and explain the challenges you have faced in formulating your opinion of value. If you have had difficulty finding information, then this must be explained in your file notes and your valuation report, but it means that your valuation rationale must be particularly clear. You must explain why you believe the value is what you think it is. What evidence do you have to support it? How have you reached your conclusions? This must be set out clearly in your file notes and in your valuation report. Do not apply an arbitrary discount to your valuation figure without a clear explanation of how you have quantified it. Over the last month or so, I've heard valuers say that they're just going to discount the value by 20% or knock off 40% or give the value a nil value to account for the current uncertainty in the market. This is not good enough without a clear explanation to support the amount of the discount. You may find it more useful to express material valuation uncertainty in qualitative terms in your commentary, as a lack of transactional evidence may make it almost impossible to support a quantitative estimate. There is guidance in a form of words for a material valuation uncertainty clause available on RICS's website, a link to which is provided at the end of this presentation. VPS 3 of Red Book deals with the minimum content for the valuation report. It's important that the valuation report reflects the matters agreed with the client in the terms of engagement, and that all matters that are listed in paragraph 2.1 of VPS 3 are included in the document. This is only the minimum content, remember, so if you want to include additional matters, then you can. Just as in the terms of engagement, the purpose of the valuation must be made clear and unambiguous. You must state clearly who may use the report and for what purpose. The limits of your inspections and investigations must be made clear, along with the consequent assumptions and special assumptions, and you must provide a clear valuation rationale to link the information you've relied upon to the valuation figure. As we've already covered, the valuer should expressly draw attention to and comment on any issues resulting in material uncertainty as at the specified valuation date. VPS 4 deals with the basis of value, assumptions and special assumptions, and underpins the valuer's professional understanding. It should go without saying that the valuer must use the correct basis of value with the correct definition, otherwise the validity of the valuation may be questioned and the professional credibility of the valuer undermined. If you're valuing a property to national valuation standards, you must still follow the requirements of Red Book Global, but the basis of value is something that will often be taken from the national standards instead of VPS 4 of Red Book. If you're required to use a national basis of value not defined in Red Book, you must make sure you include a clear definition in your terms of engagement and valuation report and make it clear that this is not an IVS basis of value. If it is mandatory for you to use a basis of value that is not in Red Book, that is not a departure. But if you voluntarily choose to use a basis of value that is not in Red Book, that is a departure, and you must state that this is the case in the terms of engagement and valuation report. You must also explain in the report why you have chosen to adopt a different basis of value. Assumptions are fundamental to the valuation, and an incorrect assumption can lead to an incorrect value. Assumptions are often a consequence of gaps in the valuer's knowledge, either because the valuer was unable to obtain the necessary information or because the valuer agreed with the client that he would not investigate certain matters and would accept that the matter is true without specific investigation or verification. Anything you do not know for a fact must be covered by a reasonable assumption, and you may find at the moment that you will have to make more assumptions than usual, as information is harder to find. As long as you are clear with the client about the information you were able to find and the assumptions you've had to make, and as long as those assumptions are reasonable, you will be mitigating the risk to yourself. If you feel you would have to make too many assumptions, or if the assumptions you're forced to make in the circumstances may not be reasonable, then you should decline the instruction. A special assumption is an assumption that you know is not factually correct at the valuation date, or an assumption that would not be made by a typical market participant. For example, if you're valuing a property on the assumption that it has planning permission to be extended, when you know for a fact that planning permission hasn't yet been granted, that is a special assumption. You know the property does not have planning permission, but you are assuming it does. Again, special assumptions must be reasonable, and there is significant risk attached here, so use special assumptions with caution. They must be agreed upfront with the client in the terms of engagement, and the report must comment on the likelihood of the special assumption being fulfilled. If the client asks you to adopt a special assumption that you think is unrealistic, you should decline the instruction. VPS 5 covers valuation approaches and methods. The three defined approaches are market approach, which we used to know as the comparable method, income approach, which is the investment and profits methods, and cost approach, which is the discounted replacement cost and residual methods. It goes without saying that a failure to use the correct valuation approach will result in a misleading or simply wrong valuation and put the client and associated stakeholders at risk, so care must be taken. Your approach should be explained in the valuation report, and you should also be prepared to justify your choice of approach if challenged. Towards the back of Red Book Global are the 10 valuation applications, or VPGAs, which are concerned with the application and implementation of the global standards in specific contexts. Whilst not of mandatory status, compliance with the individual VPGA content is essential to demonstrating the valuer's expertise. Any departure from the guidance should be explained and justified in the valuation report, as the individual VPGAs provide a definition of best practice. Demonstration of knowledge of the contents of the applicable VPGAs underpins the validity of the valuation process and approach, and if you choose not to follow them, you may be opening yourself up to future criticism, which should be avoided as much as possible in the current climate. To help us understand how to minimize risk, it's useful to look at common compliance failings so we know what to do to avoid doing in our own files and documents. The most common failings we see under PS2 are the failure of the valuer to demonstrate his or her competence to carry out valuations in that particular geographic area or of that particular type of asset. So make sure you're always acting within your area of expertise and knowledge, particularly in these times of heightened valuation uncertainty. We often see the failure of the valuer to carry out or to record on file the findings of the prior involvement and conflict of interest checks, or we find that the checks are not robust enough. So make sure the checks relate to the property and the parties to the instruction and are in relation to the individual valuer and the wider firm across all departments. We also see valuation reports that have been signed by a registered valuer, although the report was actually prepared by someone who is not a registered valuer. The person signing the report must be a registered valuer who takes full responsibility for the report. If you are signing a valuation report that you didn't prepare yourself, you must at least have supervised the preparation of the valuation, and evidence of that supervision must be recorded on file. If you sign the report and take responsibility for it, you must be prepared to answer detailed questions about it if the valuation is challenged at a later date. If you can't do that, Don't take responsibility for it by signing it. Under VPS 1, we see failure to issue terms of engagement at all, which is wholly unacceptable and puts the valuer at significant risk. Your terms of engagement is the evidence of what you agreed with the client. So if you don't have them, it will be your word against theirs if the client complains and says you didn't do what they instructed you to do. We see many statements that are generic rather than case-specific to the particular instruction, which means that the client can't be clear on exactly what the valuer is going to be doing, and this opens up the valuer to risk of criticism. Remember, the terms of engagement must be bespoke to the instruction, as standard statements can be misleading or incorrect. We see terms of engagement where the valuer or valuers fail to identify themselves. Valuer registration is a scheme for individual members, not for firms, so you must identify who the responsible individuals will be. Terms of engagement also commonly omit the purpose of the valuation or state that the purpose will be to provide an opinion of market value. This is not a purpose. The purpose is why the client wants this valuation. And once you've established that, you then know what basis of value to adopt, what assumptions to make, what specific rules to follow, etc. Remember, if your client won't tell you the purpose, think about declining the instruction. If the client uses the report for something you hadn't intended, it could open you up to greater risk. We also find that the extent and limitations of the valuer's due diligence are omitted or very limited or standard and generic. You must be explicit with your client about what you will and will not be doing as part of this valuation instruction, what you will be investigating and what you will not investigate or verify. This sets out your scope of work and helps limit your liability. So stating the limits of your due diligence on a case-specific basis is extremely important in limiting risk. Likewise, valuers often fail to tell the client where they are going to get their information from, which is a requirement of VPS 1. The sources of your information should be reliable, and your client is entitled to know how you are going to gather your information and what steps you will take to verify it. We often find that the valuer's assumptions and special assumptions are either omitted or generic, which opens the valuer up to risk. If you are going to be making assumptions, you must tell the client up front what they will be and why you are making them. So link them to the limits of your investigations. For example, say something like, I am not going to carry out any planning inquiries and will therefore assume that the property is in lawful use. The same applies to special assumptions. Identify any special assumptions clearly in the terms of engagement so they do not come as a surprise to the client when they receive the valuation report. In respect of VPS 2, we often see illegible or unstructured site inspection notes on file. The notes must be legible in accordance with VPS 2, and they must be professionally adequate for the purpose. If you're challenged at a later date, you may need to refer back to them and make sense of exactly what you did, what you saw, and what you thought about your findings. The notes we see are often too brief to satisfy the requirements of Red Book, so make sure you have regard to VPGA 8 when compiling your site inspection notes. VPGA 8 is best practice, and if you can say you followed best practice, you will minimize risk to yourself. The rule of thumb is not to have anything in your valuation report that is not backed up by a file note. So if your valuation report says that the property is located on a busy main road opposite a school, your site inspection notes should also say that to support the statement in the report. We often see lots of photographs instead of written site notes. It is fine to include photographs, but they should supplement and not replace your written site notes. Written notes are specific where a picture is not, and specific comments are more useful for demonstrating your analysis of your findings. If you're using externally sourced material such as floor plans or information from the client, make sure the source is noted on them so you can demonstrate that they came from a reliable source and that the information is verifiable. A trustworthy, reliable source will put you at far less risk than an unknown one. The valuation process is also covered by VPS2, and in respect of this, we often find that the comparable evidence is undated, unsourced, or has not been analysed. You must be able to demonstrate where you found the data, how you verified its reliability, and how you analysed it. So your file will show that you took a logical, methodical, and sensible approach to the valuation. We often find that there is no valuation calculation or valuation rationale on file, or that there is a calculation but no rationale for the inputs. Whilst the report may explain this, your rationale with contemporaneous notes of your thought process should also be in the working papers on file. In the current pandemic, when reliable transactional evidence may be extremely hard to find, a robust rationale on file is more important than ever. In order to mitigate the risk to yourself, you must be totally clear about what evidence you've gathered, how you've analysed it, how you've adjusted it, why you've adjusted it, and how it has brought you to your opinion of value. This rationale on file must be robust, as it may be your primary defence if you're faced with a later challenge. As I've already said, do not apply an arbitrary discount or a nil value just because you are unsure of what the value should be. If you are too unsure to formulate a defendable opinion, then you should decline the instruction. Discounts and nil values must be supported by evidence and/or a clear valuation rationale, just like any other value. This also applies to yields, cap rates, values per square metre, discount rates, etc. Make sure your notes explain why you have chosen the rates and the values you have. Nothing should be arbitrary, as this will put you and your client at significant risk. VPS3 covers the minimum content of valuation reports, and a compliance failing we often see is that the identity or identities of the valuers are omitted. For example, a valuer may have signed the report but not stated anywhere in the report that he is also the valuer responsible. Just being the signatory is not enough. The report must state who the responsible valuer or valuers are. Similarly, we see valuation reports signed by a registered valuer who did not prepare or supervise the valuation. Remember, if you sign the report as a registered valuer, you must be prepared to defend it, and the file must demonstrate that if you did not prepare it, you did at least supervise it. We should be able to see your fingerprints, as it were, all over the working papers in the file. As I mentioned with the terms of engagement, a clear purpose is often missing from the valuation report. In order to demonstrate that you have prepared a valuation report that is fit for your client's purpose and thereby minimize the risk of criticism to yourself, you must be absolutely clear about what the client intends to use the report for, be it secured lending, taxation, purchase, whatever. Again, just as in the terms of engagement, the nature and extent of the valuer's work, the nature and sources of information relied upon, and the valuer's assumptions and special assumptions are often either missing from the report, much too limited to be meaningful, or generic and not specific to the particular case. Your valuation report must state what you investigated, where you got your information from, what you didn't investigate, and what you assumed as a result of not carrying out that investigation. These areas are where significant risk lies, as if you fail to do something you should have done, or if you rely on unreliable information, or if you make an unreasonable assumption, the valuation will be rendered unreliable or unusable. Your client can suffer financial loss, and you can find yourself in deep trouble. So follow the rules carefully and be specific about what you've done, what you've assumed, and the reasons for your assumptions. We also find that although most reports do include a section about the valuer's approach and reasoning, they are often very vague and don't actually tell the client how or why the valuer reached his conclusions. We often see a list of comparable evidence, but then no explanation of how that information has been used to inform the valuer's opinion of value. You need to include a statement that links your evidence to your opinion of value. Don't just explain what you've done, also explain your thought process. You may feel like this is opening you up to criticism from your client, but it is part of your job as a valuer to be prepared to justify your opinion. If you are professional, logical, methodical, and transparent, you should be able to justify and defend your opinion with no difficulty, and any criticism will be rebuffed. One of the most common things we see is busy valuers cutting and pasting paragraphs from old valuation reports into new valuation reports. Whilst this may seem like a time-saving strategy, it means that errors or irrelevant information from the old report can transfer into the new report and may get missed when the report is being checked. It is safer to use a new template for each new report and be extremely careful about importing information from previous reports. Even if the error does not impact on the valuation advice, it will undermine your professional credibility and make you look lazy or slapdash. VPS 4, as we've already seen, deals with bases of value, assumptions, and special assumptions. We very often see the basis of value defined incorrectly, with valuers using obsolete or incorrect definitions for the valuation purpose. Make sure the basis of value you're using is the correct one for the purpose. You may need to refer to the national supplement of the Red Book for this, depending on what country you're in, and that you're using the correct definition. If you don't, you may at worst end up with an incorrect value, and at best have your professional credibility undermined by demonstrating a lack of knowledge of the relevant standards. As we've already said, unexplained or generic assumptions and unclear or unreasonable special assumptions can be grossly misleading and bring you to the wrong conclusion. So be careful with those, as it's a common area of failure. And lastly, make sure the statements in your valuation report match those in your terms of engagement as agreed with the client. You do not want to find yourself in the situation where you've prepared a valuation report that does not reflect the scope of work you agreed with your client. Remember that the terms of engagement are a living document and are not set in stone, so if something changes during the course of the instruction, you can amend and update the terms of engagement. You can either do this by issuing completely new terms of engagement, or you can agree an amendment or a supplement to the original terms of engagement in a side letter. Just make sure everything that you agree with your client is kept together on your file. VPS 5 is about valuation approaches and methodology, and we very often see a lack of clarity around the methodology and a failure to state the approaches and methods used. Your client is entitled to know what approach you took and how you came to your opinion of value. We sometimes see that the valuer has adopted an incorrect method and has produced a wholly misleading and incorrect value, which brings into question the valuer's competence and can lead to major trouble with the client and the possibility of disciplinary action by RICS. It's very hard to defend taking the wrong approach, so make absolutely sure that the method you employ is the correct one for the purpose and the asset type. The wrong approach will put you and your client at huge risk. So if you are not absolutely sure how to undertake the valuation, you should decline the instruction and leave it to someone who does know how to approach it. We're coming to the end of the presentation now, so the lessons I would like you to take away with you today are: always create an audit trail in the case file to support the valuation, right from the first contact with the client through to issuing the valuation report. Your first and best defense to a claim of negligence is the ability to say, I have done it by the book. If I have done it by the book, I have not been negligent. The client may not agree with your valuation and the value may turn out to be wrong, but if you have followed the Red Book requirements and guidance, you will not have been negligent. Compliance with Red Book also satisfies Rule 4 of the RICS Rules of Conduct for Members, which says members shall carry out their professional work with due skill, care and diligence, and with proper regard for the technical standards expected of them. If you can demonstrate you have carried out your work in this way, you will significantly minimise the risk to yourself, your client, and RICS's reputation. This slide shows some useful links to areas of the RICS website where you can find useful information on valuation, training and CPD, particularly during the COVID-19 pandemic. The first link will take you to the 2020 Red Book Global, with which you should all familiarise yourselves, and the second takes you to the framework documents I mentioned, which can be used as a basis for compliant templates, so I would urge you to have a look at those. That's the end of the presentation. So my colleague John Bagley and I will do our best to answer your questions, which have been coming in thick and fast on the text while I've been talking. So John, are you there?
I am, Charlie. Thank you very much, and good morning all. I think there's a representation from outside the UK as well, so good morning. I hope we're all keeping safe in the rather strange times at the moment. So yeah, let's see how we can help you with the questions. Please do fire them across.
Right, the first question here says, you mentioned the residual value is a cost approach. However, I find argument that why can't I scroll it,
It's a blend of all three approaches. Market approach for reaching a sale price for calculating the gross development value. Income incentive is seen from a developer's perspective and takes into account the property's potential. Cost is pretty straightforward. I think we'd probably agree there, Charlie, wouldn't we?
Yes, we would agree, absolutely, yes.
It's a mix of all three, and probably cost, yeah, is probably the more straightforward in most cases.
I mean, the same can be said for actually most approaches, couldn't they? They're a mix of all the approaches. Almost all of them depend in some way on the comparable approach, for sure. So yes, yeah, we would agree.
Agreed. Okay. Can we download the presentation? The answer presumably is yes, and it's being recorded as well.
Yes, it is being recorded, and yes, you will be able to download it. In the next couple of days, we're going to put it on the RICS website in the COVID-19 section, which is, there's a whole section of the website that's dedicated to RICS's response to the coronavirus pandemic. So yes, it will be there, but maybe not for a day or two. Can we receive a copy of the presentation by email? I don't see why not, actually, because actually that depends on whether or not we gathered the people's emails. If we've got your email addresses from where you registered, then yes, we can send it by email, yes.
Superb presentation. It should be mandatory for all registered valuers.
Oh, thank you very much.
Well, yeah, I would agree entirely. I've been sat here listening. Yeah, I agree. It should be mandatory. There are some really important points that Charlie mentioned throughout the presentation, and certainly in the current COVID-19 times, where from a valuation perspective, certainly transactional evidence is a lot thinner than it has been previously. So really do think very carefully about the valuation. I would also strongly urge, if you haven't done already, is to read the section on the RICS website about COVID-19, and there's some very good guidance documents around valuation. And also there's a standard set of words for the valuation material uncertainty clause, should you feel that the markets are uncertain at the moment.
Yes, absolutely.
Okay, any more questions? As chair of the Dutch board.
Sorry, do you have a template on audit trail? No, we don't, but those 6 things that I listed are really all you need to have in your audit trail to defend you. Obviously, your file can include whatever you want it to include, and will probably include more than those sort of 6 headings that I mentioned. But as long as you have the file note of your prior involvement and conflict of interest check, your agreed terms of engagement, your site inspection notes and all your desktop inquiries, all the information you relied upon, all the transactional evidence you found in your analysis and your rationale, your valuation report, your calculations, all of that, as long as that is all on file, you will have the audit trail that we require as a regulator. But, all your correspondence, all your photographs, all that kind of stuff, obviously you'll probably keep on file as well, but that's up to you. But yeah, in terms of the audit trail, really, I suppose Red Book itself lays out what needs to be in the audit trail. You've got PS2 and then VPS1 to VPS3, basically. Those parts are the audit trail, and VPS4 and VPS5 and PS1 kind of will fall naturally into that audit trail if you followed the requirements of PS2 and VPS1 to VPS3. Is there a note template?
I presume that's selling notes. Is that site notes, presumably?
Yes, well, there are site notes, site note templates available to download from iServe, which is free at the moment. It's free until the end of June, access to iServe. And there are site inspection notes for all sorts of different types of property, because of course, you know, you'll look at different things. If you're looking at a house, it's going to be different than if you're looking at an industrial unit, for example. So yes, if you subscribe to iServe, which as I say is free until the end of June, you can download templates for all sorts of things, including site inspection notes.
Yeah, I think Panos has just confirmed what it was site notes, so thank you for that clarification.
Lovely.
Okay, how do you deal with the cost side of things, especially when dealing with valuations for mortgage lending and underwriting, when banks pay between 50 to 150 euros per valuation report of residential properties? I'm going to assume, Panos, you're talking about the risk and reward type conversation, this sort of downward trend on fees. I hope you're talking about that because that's what my answer is going to be. So the yeah, it is an ever ongoing challenge with fee levels across all the sort of the valuation space, but your overriding obligation remains to provide a professional opinion of value. So the extent of fee received is not relevant to the quality of advice that you need to be giving to your clients. If you mean something else about cost, then please drop us another question. But I've answered it on the assumption it's the risk and reward type approach.
I mean, in terms of the cost, because obviously time you spend is, you know, it's cost to you as a valuer and to your firm. And although there is no requirement for you to use templates, we do find that once you've got compliant templates in place, it can actually speed up your work. So it has a double benefit. You know, you can get through your work faster and remain compliant, because what we don't want is for you to rush through and get it wrong. You know, and now more than ever, your clients are watching you. They're watching you more closely than they ever have before. So you really, really need to be careful and make sure you are allocating enough time to do a proper, professional, defendable job, even if your fee is only 50 euros. I mean, why you would only charge 50 euros, I don't know. Because remember, you are a professional person. You have got loads of market knowledge, years of experience behind you. Don't just give it away for 50 euros. You know, if somebody else is willing to put themselves at risk and do it for 50 euros, let them do it. You know, don't be tempted to do half a job for half a fee.
Yeah, thanks, Joe. Here. Yeah, I mean, just to reinforce that, the fee level, there is a general downward trend. It has to be said, but reinforcing Charlie's point there, I've seen in my previous life where the case file has come through and the comment has been, well, what did they expect? They only charged £75.
Yeah.
In UK terms, well, that's you're still judged on the same standard, whether it's £1,000, €1,000, or 25. But yeah, that risk and reward is a difficult balancing act at the moment, isn't it?
Yes, it is.
Okay. This says, dear Charlie, so I shall.
In some cases, customers ask us to use at least 2 valuation methods. Yes. Do you think this is appropriate? Well, that really is up to you, but I think certainly at the current time where you need to be extra careful, there's nothing wrong in, you know, using a couple of different valuation methods and seeing what difference it makes to the value, so you can kind of, you know, it's like a cross check and see what difference there is, see the sensitivities in the approaches. I mean, in some cases, of course, there is a correct approach and only one correct approach. So in those cases, it would be inappropriate to even try a different approach. And I think valuers have got a bit of a task on their hands and a duty to educate their clients, you know, particularly the banks, who have quite a lot of power over valuers, you know, and they're guilty of squeezing valuers' fees down and making demands that can be unreasonable sometimes. And I think valuers really do need to push back where you are being asked to do something unreasonable. But in terms of using different valuation approaches where there may be more than one approach that could be appropriate, then yes, I think maybe in some cases it's a useful exercise.
Yeah, sometimes we talk about triangulating, maybe using 2 or 3 evaluation methods just as a sense check, just to make sure you're in the right ballpark figure for your valuation. Next 2 questions are probably linked, I think, Charlie. So about COVID-19. So first question is, in case the market has fully stopped where comparable shows market condition before COVID, how can anyone perform valuation? This is the case in Serbia. No transactions for 2 months. That's probably consistent across most of the markets, actually. How can we estimate the risk for the next years after COVID? 2 really good questions. Probably the most challenging times that I've been aware of in valuation, so the last 25 years or so. I would really emphasise the point about using the material valuation uncertainty clause. So it really sort of puts the valuation into context for your client. In terms of a lack of transactional evidence for the last 2 months, it is a consistent picture. We're looking at whether we need to issue additional guidance, so we are looking at that as we speak, but also the advice is to use as wide a range of data sets as you can possibly think of. So if transactional evidence is limited in direct sales, then you widen the net further afield to different types of transactions. In the commercial space, maybe looking at sort of stock market movements, looking at other types of data that you can underpin your valuation rationale. But again, reinforcing Charlie's point from before, the key here is really a strong, sound rationale to your valuation, and really have as much evidence as you can have to support that, and it will continue to be challenging. But I would again re-emphasize, if from the question the market is uncertain, which is what you're saying, you must use that material valuation uncertainty clause, which will allow the client to understand that there's less certainty around the valuation than would normally be the case.
Yeah, because in terms of the evidence, if you are lacking evidence, and of course you will be if the market has fully stopped, you then need to make some assumptions, but of course the assumptions have to be reasonable. So at the moment, really, all you can do is rely on the evidence that you do have, which you know is out of date. And as John says, use that material valuation uncertainty clause to let the client know that you understand that something has changed between the date of your evidence and now, and that it's hard to quantify it. You know, in the presentation I was talking about, you might be better off using a qualitative statement, you know, in your commentary, rather than trying to quantify it. If you don't have empirical data, you can't quantify it. So you can't just say, I'll discount this value by 50%, for example. You know, you still need to have the evidence to support those quantitative adjustments to your valuation. So yes, the rationale, if you choose to make these kind of adjustments, your rationale needs to be really clear. You need to know yourself why you're doing it. Don't just guess. Don't just guess at a discount. Don't just say, I'll put 0 on this value because I don't know. If you really can't come up with a value that you're happy with, then decline the instruction. And it could be that every valuer in Serbia has to say, sorry, we can't do a valuation. But, you know, that might be the way it has to be, and your clients will have to understand why. But estimating the risk for the next years, that's a difficult one, because the market will reflect circumstances, of course, and at some point somebody is going to buy something somewhere. You know, even when we have these pandemics, even when clients can't view the property at the right price, they will still spend money on acquiring and selling properties. And so the hope is that evidence will start to come through. You know, you will start to get some kind of picture of how the market is treating this, and you will start to get some evidence, and that will help you estimate the risk.
Yeah, the market will, a new normal will appear, and you are valuing, it's a spot figure as of the date of valuation, isn't it? So you are reflecting known facts the date of your valuation.
Yeah. And also, I mean, when somebody buys a property, although they buy it at that moment in time, and that is your evidence, that purchaser is looking to the future as well. So, you get some kind of idea about market sentiment for the future and risk for the future by, through purchasers' current attitude. Purchasers aren't just buying in the moment, they are thinking about, their futures. And so you can take that as quite strong market sentiment, I would have thought. Any more questions from anybody? Well, that's pretty, small one.
Oh, questions come through. Hi, Charlie.
Oh, sorry. Departure. Is the departure only if I choose it voluntary? If the local standards force me as a valuer to choose, yeah, well, that's right. If the local standards force you to choose another basis of value that's not mentioned in VPS4, no, it's not a departure. You have to mention it. You have to say in the terms of engagement that you are using this basis of value. You have to say where the basis of value comes from. So it comes from the local standards, and name that local standard. You also need to give the definition of that local standard basis of value. You should also highlight that it is not a VPS4 definition of value, and explain the reason, and say, it's mandatory for this purpose in this country to use this basis of value. And so, no, it's not a departure, but that doesn't mean you don't have to mention it. You do have to mention it. But no, if you choose, sorry, I was just going to say, if you choose to depart, then you need to give a very good reason why you've chosen something that's not Red Book.
Nothing to add there. Nothing to add.
Okay. When you have to evaluate a piece of land which has to be developed, do you always have to visit this? Well, no, I guess no. I mean, it's up to you, but yes, it does depend. It depends on what information you need. If a site inspection wouldn't give you any additional information, then no. But I mean, we always say the first rule of valuation is that you can't value something you haven't seen. So you may find that if you did a site inspection, you would discover things that you wouldn't know otherwise. But if you're not going to do a site inspection, you do need a reason for it, why you would choose not to do one, and it needs to be agreed with the client. But any restrictions like that, no site inspection, or you're not going to do any investigations of this matter or that matter, need to be agreed with the client, and you need to make clear what your assumption is going to be. So if you're not going to visit that development site, you're going to make some assumptions about what's there, and they need to be reasonable. But I mean, you are under a duty to verify the information that you rely upon, and really the easiest way to verify what's on the ground is to visit. But
yeah, you need to, it's your professional role to provide a valuation, so you need to see as much of the asset as you need to see to form a professional opinion. And doing that sort of site development value, then let's say there's a nuclear power station next door that you're not aware of, will that have a difference on value? Probably yes. So, and you've not spotted that, so then you're potentially completing a false valuation report, aren't you? So ultimately it's the call of the member whether to go out onto site, but you have to gather as much information as you need to be able to form a professional opinion or value. So read into that as you will.
Yeah. New standards from Red Book 2020. Yes, the new one became effective on the 31st of January 2020. And actually, I mean, there aren't that many changes, are there, John, from the 2017 Red Book?
No.
But there is a much stronger requirement for you to use some professional skepticism. So if you are relying on information from a third party, and particularly from the client, don't just accept that information as being true. Take some steps to verify it, and because a client, of course, has a particular agenda. They want to push you in a particular direction. And sometimes, obviously not always, but sometimes clients can give us as valuers misleading information because it works in their interests. So make sure that everything you get from any source is reliable and verifiable, and that it won't produce a misleading valuation. Is hope value an implicit part of market value? Well, yes is the short answer. Would you agree, John?
Yeah, I mean, you are valuing to a willing buyer, willing seller. So it's obviously you have to disregard some special needs of certain purchasers who may well pay above market value. So you are assessing what would a willing buyer, willing seller transact at the date of valuation. If the market is consistent and there's an element of hope within that, and that's consistent across all willing buyers, willing sellers, then I suppose yes, there's an element of that, but it's about making sure you don't take into account sort of the special purchasing needs of one particular purchaser. Well, you are taking into account the overall market, the sort of generic willing buyer, willing seller. It depends on what your assessment of what those two parties will transact at.
Yeah. An interesting question here. How many, I think that's judicial, successful cases are there from clients against RICS valuers concerning valuation reports? Well, per region. Well, it does vary from region to region. I mean, for example, if you take Germany, Germany has never, ever had a case against a valuer. There have been cases against valuations that were carried out in Germany, but they haven't been conducted in Germany. There was one, I think, that came to the court in London. But I mean, I think the UK by far has a more litigious culture. But even here, I mean, recently in the past couple of years, there actually haven't been any successful. Well, nobody has sued a valuer to the point where it went to court. But speaking to lawyers in the UK, they are of the opinion that clients are waiting for the moment, and that, when the time is right, there will be a lot more cases against valuers. And that kind of litigious attitude is starting to spread across Europe. So it's actually, at the moment, it's quite quiet on the litigation front. But we're expecting that to change, and lawyers are telling us that they're expecting that to change quite soon, unfortunately.
Yeah, it's an interesting one. Claims levels, so claims levels in the UK certainly are at historical low, but it's cyclical. So the market, I think most insurers are expecting the market to downturn, and that was before COVID-19. And following a market downturn, inevitably there's a challenge on valuation figures. So there is kind of a belief that claim levels will start to rise, but that really very much depends how the market performs. But in terms of since the global financial crisis of 2009, the claims levels have maintained at a very low level. But yeah. I think Charlie's right. Litigiously, in the UK, we are probably more keen to pursue our valuers than in other parts of Europe, and that is quite often a lender-based complaint rather than individual clients. So yeah. It all depends how the market performs, really. If the market bounces back, then inevitably there's less opportunity to challenge the valuation. If the market turns and economically properties are possessed, that's traditionally where claims do follow, unfortunately.
Yeah, I mean, the way clients punish valuers in the rest of Europe, it seems to be through reputational damage. You know, if they don't like what you've done, they won't use you again, and they tell everybody they know not to use you either. And so, you know, rather than take it to court like they do in the UK, they punish you in other ways. And you don't want reputational damage. You know, once your reputation has been, you know, muddied, it's very hard to get your reputation back again, because of course people talk, and if people are pleased with your work, they tell one person. If they're not pleased with your work, they tell 10 people. So you know, you need to be careful, even if you're not at risk of going to court with this, you know, just to protect your own reputation.
Give you the best chance of success in any challenge by following the rules.
Yeah, yeah.
Okay, I think the questions seem to have stopped, which is great.
Yes.
Which means it's a fantastic presentation. I mean, Charlie.
Oh, thank you. Thank you very much. Well, if it turns out that we've missed any of the questions that you've submitted, then apologies, but we'll do our best to answer them either on the frequently asked questions section of the website, or if there are any very specific questions and we've got your email, we will reply to you by email. So thank you everybody for listening, and thank you, John, for your time this morning. So yes, I hope you found it useful and that you'll be able to join us on some more of these free webinars.
Indeed, and do keep safe. And do keep safe in these rather strange times, has to say.
That's it. So thanks everybody, and have a good day. Bye-bye.
Thanks all. Bye.